For some time now, China has been too big to ignore in a well-diversified investment portfolio. As the world's second largest economy and as such a key driver of global growth, as well as being the primary consumer of many commodities, where are the opportunities for investment in China? Well, Catherine Yeung is Investment Director for Fidelity International in Hong Kong, and she joins us now on camera from there. Catherine, good to talk to you. First, how would you appraise China as an investment opportunity at the moment?
When we look at China, investors perhaps shouldn't have a bias just towards what we call the new China names. So technology names, retail, consumer-driven names. What we are in fact seeing is that the old China names, some of them are actually very, very interesting. Of note, certain state-owned enterprises are really looking through reforms coming down from Beijing at ensuring management teams are more aligned with minority shareholders. So that some of these companies have got a lot of cash sitting on their balance sheet and are now distributing that cash in the form of income. So expect this total return story to keep on being developed throughout the country.
Outside of that picture, there are still some concerns, aren't there, about the quality of data on the Chinese economy, for example. Can China maintain its current level of reported growth?
When it comes to GDP growth, it's about the quality, not the quantity. And indeed, where China is in its economy in the cycle, expect GDP growth to continue to trend downwards. It will be the new norm. And along with this trending downwards of growth, the government's really focusing on ensuring that Chinese companies, the economy overall, is climbing up the value chain. So China's not going to be the world's largest manufacturer of toys anymore. It's looking at companies, it's encouraging companies to be a lot more innovative.
Last year, the slowdown prompted some investors to move funds elsewhere, and in response, the authorities in China implemented a series of measures to arrest this outflow. How damaging was this policy at the time on investment flows, and is this something investors now should be concerned about?
This week, we've had a number of announcements coming from the president himself, and in fact, the 25-member Politburo, so the most important policymakers of the country, along with the 4 regulatory bodies, including our central bank, the PBOC. And these announcements are all about risk control, the beginning of deleveraging. The market hasn't reacted favorably, both the bond market and the equity market this week, but generally speaking, these reforms and really cleaning up the system are positive for the long-term growth story for China. And don't forget, the Chinese government ultimately wants to open up its capital markets and its capital account.
Part of that, and the authorities there, just to continue that point, the Chinese central bank spent billions of dollars last year to slow the yuan's decline, something that led the then presidential hopeful in the States, Donald Trump, to say that China was a currency manipulator. To what degree is this putting a brake on foreign money moving in?
When we look at foreign money, there's this sort of opaqueness about the messaging which comes from the regulators, which comes from the government. If we think back to 2015, when we had a very, very strong rally or rise in the Chinese mainland market, that first half of that 2015 year period, it was all being underpinned by retail investors, Chinese investors, and a lot of leverage was in the market. So no surprise what happened in the second half in terms of the market correcting. And then, of course, economic data was slowing down. We, by the way, do expect the economy to continue to muddle its way through, so don't expect any massive upside surprises nor downside surprises. When it comes to the government, though, it's about clarifying their message, and since 2015, it's all about de-risking in terms of the government's mantra. So expect this to continue. Expect also this year to see sort of messaging from Beijing about stabilization of growth, and that's really, really important, especially as we come up to the 19th People's Congress in October.
Well, this is another thing, actually. It's about the growth and the way it's happened in China. The speed at which the Chinese economy has grown, to some is a worry. Worries are that it's been built on debt. Should this be a concern?
These recent announcements are all about the debt situation, the shadow banking system. So expect, cautionary-wise, liquidity to become tighter. The real risk for China is if we see an unexpected deceleration in growth, or, for example, if the Chinese are penalized by any kind of trade policies that come out of the US, which would hurt their trade picture. If we look at another driver of the economy, though, it's property. Property remains the backbone of Chinese economic growth. And last year, we started to see a pickup in property in the second half of last year on the upside, property inventories were coming off or coming down across the entire country, not just cities like Beijing and Shanghai versus the lower tiered cities. So now that property has stabilized, in fact, it's probably heated up a bit, you're seeing property tightening measures, which ironically, you could then see that domestic money flowing back into the equities market. But we certainly don't want a scenario like 2015 where people were just buying stocks that they perhaps didn't know the fundamentals about with a very short time horizon. There's a sort of a push towards focusing on blue chip companies, a bit like what UK investors would invest in.
Okay, well, let's pick up on that point about blue chip companies that are of appeal at the moment. You mentioned at the top of the interview that the tech sector and other areas that were particularly hot at the moment. Give us some more flesh on this bone about the opportunities for investment now in China.
If we look at the rise of the Chinese consumer, urbanization, we're talking about 1.3 billion people climbing up the J-curve, so upgrading, buying a microwave for the first time, going from a packet noodle meal to, let's say, a bowl noodle meal. All that has a lot of exciting and attractive earnings visibility if you have the right product that the consumers want to buy. If we look at Alibaba, obviously they've changed the landscape in terms of retail sales because of the whole e-commerce push. So logistic companies, also good opportunities as a result of this, sort of the evolution of e-commerce. Talking about Alibaba, they are forging ahead in cloud computing. And in fact, the addressable market for cloud computing is expected to be somewhere about 60 billion US dollars, a compounded average growth rate over the next 10 years of 34%. So there are a lot of opportunities. From a government perspective, again, we have the 2025 Make in China strategy. So the government encouraging manufacturers to climb up the value chain. So again, going back to the point about let's become more innovative as opposed to just being the copycats or the low-end manufacturers of the world.
So finally, what's on the horizon then in China? What should we be watching out for that could give us a catalyst as to might change the landscape?
Interestingly, we are going to, during the summer break, have the Beta Summit, which is where a lot of the policies will be made and then announced at the 19th People's Congress. So the 19th People's Congress in October is very, very important. Beta, which is an area in China, the summit during that period is going to be very important. A potential catalyst for markets could be with MSCI announcing A-share inclusion into their emerging market indices. And when I talk about A-shares, that's stocks listed on the Shanghai exchange as well as the Shenzhen exchange. And again, we expect to see a rebalancing of global indices, whether it's bonds, whether it's equities, because to better really reflect, as you mentioned up front, China's position on the economic landscape. Because at the moment, MSCI, even when you include Hong Kong, Chinese equities only makes up less than 3% of MSCI World. So potentially significance as a result of an announcement of inclusion.
Catherine, look, thanks. We'll have to leave it there, but thanks for joining us. Catherine Yeung, Investment Director at Fidelity International in Hong Kong.